Welcome to this video, how to create a financial plan for a fiduciary business. Before we start, if you like to see more videos from us, please push the subscribe button. In this video, we are looking at the business model of a fiduciary and will cover how to plan revenues and costs over a period of multiple years. For this video, we're going to use a financial model template from efinancialmodels.com. A link to the template used is included in the description below. The objective is to come up with a 5 to 10 year financial plan so that we can understand the income from customer mandates and foreseeable costs. So this allows us to figure out the profitability of our business plan. What we also want to do is to run scenarios to see what happens if certain mandates will expire sooner than later, or if we can manage to get new mandates, how this will impact the profitability. This financial plan will result in a comprehensive financial statement forecast, including a forecast of the income statement, balance sheet, cash flow statement, and even forecasted financial ratios, so that we can obtain a very clear picture in which direction our fiduciary business will be heading. So let's dive into it, how we can forecast the revenues and costs for a fiduciary business. For this, we need to become clear what type of mandates we are going to service. We have here a list of different types of mandates, and typically either these mandates they run indefinite, or they might also be more project-based, meaning they're running for 1, 2, 3 years and then they will end. In terms of the payment schedule, some mandates we receive the money yearly, like a yearly fee, or sometimes we are even get paid monthly. And in this model, we can simply input the yearly fee and then it will show up either as a one-time fee for the whole year, or we break it down on a monthly income. Once we're clear what type of mandate we are service in general, we are going to a sheet which basically is a list of our mandates. We define mandate for mandate, what type of mandate it is, which customer it is attached to, and what will be the yearly fees, if they're going to be paid monthly on a yearly basis, and when the mandate will start. So depending on that, the cash flows and profits will move around where I put the different start dates. And as you can see, I assume only these mandates are going to start in year 1. This is a startup fiduciary business. We expect some additional mandates to be added in the year 2. And as you can see, we always, in this case, we expect that these will come in during the year and will start therefore in different months. And either these mandates they go on indefinite, or they will expire. If they expire, that means the revenues will stop at that time. And this is especially a problem if we know that the certain things are going to change in the market. And for instance, by year 7, we can expect a lot of these mandates are going to expire. And if that's the case, then our business plan would look something like this. In that case, it would mean if we have a build-up in mandates, so at one point we could also have or run into a decline of mandates. So then we need to know how much additional revenues we need to create, and we also need to become clear in which year, which type of mandate we need to add in order to avoid a business plan which then would decline. And our forecast then also offers additional analysis. We would like to know the contribution of the mandates acquired in year 1, year 2, year 3. And as you can see, there are different patterns. In this case, a lot of year 1 mandates are expected to run out, but normally for fiduciary business, they should go on for quite a long time. So we probably would more like to see this type of revenue build up. But with this type of plan, we can clearly allocate each revenue stream to the mandate type and also customer type. This then allows us also to run an analysis how our expected customer concentrations will look like. And as we can see, there will be certain customers which will contribute a lot to our revenues. So this indicates also our dependencies and risks. If we have something like this in our plan, we would like to know about, and then we would need to work on that so that these percentages are a bit lower and we are less at risk and less dependent on those. The same thing then also on the type of services. If you have different types of services, we might also want to pay attention that we're going to diversify these a bit. So if in case some regulations would change, that we are not fully exposed in the worst case. So this is more or less how to plan revenues for a fiduciary business. In terms of planning costs, that's actually quite easy. The major cost position for a fiduciary is expected to be the employee cost. So we need a list of the staff positions, how many full-time equivalents we will employ during the years. In this case, here there's a build-up following the build-up of revenues. And then if we multiply the number of employees by the salary levels and, if applicable, even a bonus, then we can get to the salary and wage budget, which is needed over the next years. And then we can go on and also add any other operating costs, which will give us then the cost or the total operating costs on a monthly basis. In case this fiduciary business has some direct costs, normally I don't think it's the case, but in case it is, there would also be needed that we estimate some direct costs to include this in our forecast. Having all this, we will have the revenues, we will have the direct costs, we have the operating costs, and then we will have a more clear picture what will be the expected profitability of our business in the years to come. Of course, we can complement our business plan also with all the other usual assumptions, such as depreciation period, taxes, inflation, interest rates, and then also uses and sources of funds, so that in case we need to do some fundraising, we need to know how much financing we need, what it will be spent for, and then how much debt financing we can get, and the rest would have to be financed through equity, for which we will have to raise funding. And in this case, we will have a detailed monthly schedule, so that we can basically become clear on a month-to-month basis what will be the profits, and then also the expected cash position. As you can see, we have here some cash. Because we are not profitable in the first months, we will need those cash to pay for the costs. And once we're getting, where is it? Here, maybe a bit later. I hope we get profitable. I think yes, we do. And as you can see, once we get profitable, then the cash trend reverses and we start to basically add to our cash balance again. So we want to have some visibility, and we also want to know what will be the minimum cash buffer, so that when we raise funding, that we have some cushion. So in short, more or less, this is how to prepare a financial plan for a fiduciary business. We hope this video gave you some good insights how to do this. If you like this video, please give it a thumbs up, subscribe to our channel, and visit our website efinancialmodels.com. A link to the model is included in the description below. Thank you for watching.